In this video yesterday, I promised my outlook for gold prices in the intermediate as well as the short term. So let's jump into the gold price chart, and the intermediate outlook hasn't really changed over the last few weeks. All through November and December, we mentioned that this triple bottom is the end of the intermediate cycle low. Since then, we are in a new cycle, which is likely 85 days long. Although with triple bottoms, it's a bit tricky to choose the exact start of a new cycle. In either case, even if we choose the second hit of the bottom as the middle one, we are nearly a couple of months into a new intermediate cycle. Usually the cycles last for around half a year. The previous cycle was extremely long. And unusually short cycles are often followed by very long cycles and vice versa. But even if this ongoing cycle turns out to be relatively short, lasting for, say, around 5 months rather than the usual half a year, we still have quite a lot of time for this cycle to continue chugging higher. Again, as I've mentioned in a couple of my previous videos, it's likely gold price is going to continue to chug higher sometime at least into the Chinese New Year, somewhere around late January. And having a quick glance at seasonality, at least since 2015, since the end of the previous bear market, we see that seasonality generally agrees. We often see some sort of a bottom in gold price somewhere around December or November, and a seasonal push higher all the way into February. So the intermediate bullish case is still intact, and seasonality also agrees with that bullish outlook. However, stepping down to the shorter term view, to the outlook on the daily cycles, again, wherever you choose the start of the daily cycle, whether you choose this middle one, for example, or not, that gives you a daily cycle lasting for around a couple of months, or perhaps already longer than that. Usually these daily cycles in gold, with the daily cycle lows marked with these arrows, last for around a couple of months. Sometimes they do stretch to around 3 months long. We're now into a daily cycle that's been going on for 62 to 85 days. Even if you choose the most recent low, that's 49 to 85 days long of this ongoing short-term daily cycle. So while in the intermediate term, I still expect gold price to continue pushing significantly higher, in the shorter term, there are some risks of some sort of a correction, some sort of a consolidation. Let's go through a number of signs that suggest that sort of a correction. Firstly, we are observing a negative divergence on RSI. Negative divergence is a situation when RSI is showing you lower highs versus higher highs on the actual price chart. Negative divergence often, although not always, suggests that a bit of a correction is likely. Next, the gold price has already reached close to that 1840, which, as I've mentioned in several of my previous videos, has been the support resistance zone, mostly resistance zone, that has been respected for nearly a couple of years. Hence, it's quite possible, it's even likely, that there will be some sort of a bounce down from that resistance zone. Another sign suggesting that some of these resistance zones are simply aligning is this Fibonacci retracement of all of the decline of the previous intermediate cycle. As I've told you many times in a lot of my previous videos, the most commonly retraced Fibonacci numbers are the 38, 50% or the 62% retracement levels. And this 50% retracement level actually coincides pretty close to that 1840. Again, a bit of a confluence of resistance levels over here, just adding to the likelihood that there will be some sort of a correction down from those levels. Again, we're talking probabilities about the future here, as nobody knows the future for certain. Next, if you have a look at the DXY chart, the dollar index often trades inversely to the gold price. And all the way since early November and even since October, DXY index has been declining within this short-term daily cycle. And history shows that these daily cycles on DXY index last for over a couple of months. The ongoing cycle is already getting a little bit long over here at 79 days. And although nobody knows how long will this ongoing decline continue, at some point dollar will become simply too oversold, and at least a short-term bounce might take place. If not a bounce into a new intermediate cycle in the US dollar, at least a short-term correction before the dollar continues declining down into the intermediate cycle low rather than the upcoming short-term daily cycle low. And such a short-term bounce into a new daily cycle might also push gold down into that possible short-term correction from these resistance zones. Looking back at seasonality, while seasonally gold is very strong this time of the year, all the way into January and February, there are of course corrections, as you see, that align well with the general cycles view. The intermediate cycle usually rises for a few months into February, but we see short-term corrections into short-term daily cycle lows before the intermediate cycle itself drops down into the intermediate cycle low, into the end of the intermediate cycle, usually sometime into early spring. Next, looking at the optimism index in gold, we see that it's still relatively low at 42. Looking back at the intermediate cycle low in August 2018, that was pretty similar to the recent intermediate cycle low, with a very long decline into that low, and optimism index dropping extremely low, close to 20. Even a relatively modest bounce out of that very deep intermediate cycle low with very high pessimism on the market, with very low optics, brought this optimism index all the way above 60. So even if currently in the ongoing intermediate cycle, if the optimism doesn't recover all the way above 60, it should perhaps at least recover to somewhere above 50. So in the intermediate term, the outlook for gold is still bullish. But again, in the short term, there might be corrections down into those short-term daily cycle lows. Looking at a shorter-term view of this optimism index, the GLD optics, for example, you see it's more volatile, it's more jumpy as it's more of a shorter-term view. Let's put this 10-day moving average, the green line over here. We see that it's showing a bit of a negative divergence over here. The highs are slightly lower while price is showing higher highs. So perhaps either at least a sideways consolidation or maybe even a very short-term correction down into that short-term daily cycle low might be quite likely. Historically, corrections down into short-term daily cycle lows rather than intermediate cycle lows bring this 10-day moving average of this short-term optics at least down to 40, often below that. And within a couple of recent lows, it only dropped down to 52. So it's perhaps a bit hard to argue that we have already seen the short-term daily cycle low behind us in late November. So while it is likely perhaps we've seen one daily cycle low lasting for 56 days, pretty close to the average duration, and we're now in a new short-term daily cycle low that might continue for a bit longer, I think it's more likely that we are still in an ongoing daily cycle which started anywhere with one of these triple bottoms. And the daily cycle is still ongoing. It's getting quite stretched at the moment. It's reaching these resistance levels, and it might bounce down for a while from say around 1840, giving us a short-term daily cycle low and another buying opportunity into a new daily cycle. That might actually be one more buying opportunity for those who haven't been following us at myfinanceteacher.org in expectations of that previous intermediate cycle low. So for more details, feel free to join us. I frequently post updates on a range of assets, including some hidden gems as this, for example, which has already rallied handsomely. And from the beginning of January, I'm going to remove this introductory half-price offer for the first month. Have a nice day. Bye-bye.